A stock market crash can be described as a quick and often unexpected drop in stock prices. Economic crisis, catastrophic events, or the crash of a long-term speculative bubble can be reasons for a crash. Public panicking about a stock market crash can also sometimes be the cause for a stock market crash due to panic selling, resulting in depreciating prices. Famous stock market crashes occurred in 1929, resulting in the Great Depression, 1987 known as Black Monday, the dot-com bubble burst of 2001, 2008's financial crisis, and recently, 2020's pandemic crash. Now let's discuss the 5 impending signs of a stock market crash in the near future. Number 1. China's housing crisis. The world's most populated country, China, is experiencing a serious slowdown in its growth due to continuous economic threats such as inflation due to the pandemic, falling growth rates, and decreases of manufacturing processes. Meanwhile, another unfolding crisis lurks behind China's real estate and housing crisis. Since 2011, China experienced one of the weakest economic growth quarters in the period from July to September this year, with only a mere growth of 0.2%. The most significant concern for this growth slowdown has been identified as the real estate crisis. Chinese real estate companies carry an approximate $5 trillion in debt and is failing to meet multiple payments. Among this, the Chinese real estate company, Evergrande, has been noted as the biggest debt carrier with over $300 billion in debt. Under the state capitalist economic system, the market management of the Chinese government is strongly responsible for creating the environment for the rise of real estate developers as well as their downfall. Real estate developers and other related services hold about 40% of the Chinese economy. In September, the People's Bank of China announced that the company Evergrande had mismanaged their business, but have stated that the risk to the financial system is still very much controllable. However, stock markets around the world are concerned over the massive defaults of the Evergrande Group, as it is the biggest real estate developer in China. If the Evergrande Corporation happens to collapse, the Chinese economy would face a huge blow and a domino effect on other sectors of the financial system, including several other domestic sectors, such as banks and other mainstream financial systems involved with this will crash. Nonetheless, it will affect the global economy, including financial institutions, which are directly and indirectly linked to the real estate business. As investors around the world have invested in shares of this company, it would lead to the breaking of social stability, supply chains, and credit stress. At the time of writing this, Evergrande has less than a month left to make late payments and avoid defaults. With the deadline looming closer, the company struggles to raise cash while the world economy is on the lookout for a gray rhino risk, a risk that we can see and acknowledge but do nothing to avert it. Therefore, if the Evergrande Group collapses, it could result in a spillover effect and massive job losses could occur. Not only that, the global economy will also be highly affected as foreign banks have high exposure to the Evergrande Group. Number 2. The 2020 pandemic. The 2020 SARS pandemic has had severe impacts ranging upon a wide area of the economy, including the stock market. Some major events are the Russia-Saudi Arabia war over oil price, which resulted in the collapse of the crude oil market and a role in the 2020 market crash. The short-term impacts of the COVID-19 pandemic include limited economic activity due to strict quarantine restrictions, while long-term effects include a huge unemployment rate and the failure of many businesses, resulting in severe negative world economic impacts. The unemployment rate during the pandemic period rose from 3.6% to 10.1% in America, bringing the global economy to a standstill by disrupting domestic markets. Many people had lost their jobs or are working on a low salary with the pandemic. According to the International Monetary Fund, job expansion has come to a standstill around the world. With the downfall of industries such as tourism and hospitality, millions of people who lost their jobs have been included in government-supported job retention plans. Even though we are currently in a period of recovering from the impacts of the pandemic, job opportunities are still low in many countries around the world, such as Britain and Canada. The impact of the COVID-19 pandemic can be well understood by the fact that the circuit breaker mechanism, which can temporarily halt all trading on an exchange due to volatility or instability, was activated 4 times within 10 days in March of 2020. The frequency of this has not been so high before, indicating the fragility of the stock market during the pandemic. According to the widely accepted concept of behavior of finances, situations like pandemics often lead to a downfall of the efficient hypothesis of the market by causing asset values to deviate from their basic values. Number 3. Inflation. The impact of the pandemic on inflation is uncertain, as there are constant supply and demand processes that tilt the balance towards inflation or deflation. Inflation could lead to structural changes in the stock market, leading to revealing the fragility of supply chains around the globe. Companies had to rethink the geographical distribution and redistribution of their products, resulting in major structural changes to economic processes. Moreover, this pandemic could have a long-term impact on the behavior of businesses as well as consumers, as they could become more cautious in consumption patterns by minimizing lavish money spending and focusing on essential needs and investments. According to many economic analysts, this situation could lead to permanent changes in consumption baskets and patterns of the global economy. For instance, consumers would be more incentivized to save their money rather than spend it, with the idea of saving their money for later or for future emergencies. When considering structural changes in the stock market, the issuing of stimulus checks has taken a prominent place as governments were more concerned in stimulating the economy by providing the public with money to spend and satisfy their essential needs such as food, medicine, and shelter. In fact, the U.S. government has issued an amount of $2 trillion on these checks. In many cases, stimulus checks were being reinvested into the stock market, thus creating a false image of the stability of the stock market. This resulted in a significant uprise in the stock market, with companies increasing more than 50% during its recovery period. In the European market, the production of goods such as medicines, pharmaceuticals, and food is encouraged to increase production. This could result in reversing the disinflationary effect of globalization in the past few decades. Due to increased amount of confirmed viral cases, drastic changes in oil prices and exchange rates, and significant fears and uncertainties of investors, there are many signs that signify instability in the stock market. Number 4. Hedge funds and overleveraging. A hedge fund can be simply described as a pooled investment fund that trades in liquid assets and is able to make use of complex trading patterns, including risk management techniques, to improve performance. Hedge funds are capable of manipulating stock prices with their vast surplus of cash, as well as the ability to overleverage, whereby they borrow funds from banks and institutions to participate in more trades even if they do not have enough cash to make the transactions. Although the motive of hedge funds is to go up in a bull market and not lose money in a bear market, they tend to underperform during stock crisis periods. For example, Bill Hwang, the founder of the Archegos Family Hedge Fund, suffered heavy losses in a matter of days, wiping out the whole fortune of over $20 billion in mere days. Let's take a look at how this happened and how it would affect an impending stock market crisis. The worries that came out from Archegos Capital Management led to the decline of share prices of many banks. U.S. media stocks suffered more than 27% downfall with the severe selling pressure, while some Chinese internet ADR or American depository receipts suffered the same sell-offs on a similar scale. In this situation, Archegos had built massive positions in the stock market and had to give up more than $20 billion to cover up the losses due to massive margin calls caused by prime brokers rushing to exit their positions on Archegos' behalf. This created a tense situation in the global stock market, bringing out signs of an impending crisis. Archegos used substantial leverage funding to a point where its gains became non-existent as stock prices fell 20% of their buy-ins. Thinking they could pocket the lending fees and manage the risks, Archegos' portfolio crashed. The involved shares suffered heavy depreciation and banks had to withdraw from their position in Archegos. Banks lost a lot of money as a result of Archegos. For example, Japanese bank Nomura had lost over $2 billion alone in this matter. Being the greatest trader at one point, Bill Hwang lost more than $20 billion on the Archegos hedge fund, affecting stocks and mainstream financial systems all around the globe. Number 5. Meme stocks. A meme stock can be described as shares of a company that have become popular among investors through social media platforms. They build up online communities and build popularity around a company stock through discussion boards. With this being said, these communities can greatly influence the price of meme stocks. Examples of some popular meme stocks are GME and AMC. These stocks are named meme stocks based on its portrayal on social media. However, with the meme status, they have been able to reveal the fraudulency of certain so-called market experts by proving their facts wrong and exposing corruption in the stock market by bringing into light how major financial systems can fool retail investors. GME and AMC shareholders set the stage for understanding what's wrong with the stock market. The opinion of the public about the stock market as a pure, fair and equitable place has been challenged and is still unresolved. Due to the GME community, facts about stock market corruption by mainstream media experts were shown to be extremely biased, expressing negative facts about it with no fundamental or logical support, and blatant stock market manipulation has also become a popular topic within the GME community. In one article, it was discussed how hedge funds paved the way for a crisis in the stock market. One forum argues that because hedge funds possess a lot of money, they have the ability to throw more money in the market to create massive losses to the retail community and putting companies at risk. In a similar fashion, hedge funds can use algorithmic strategies such as the short ladder attacks, where they bid on low-priced shares and purchase it from one another to drive prices even lower. Moreover, a strong argument presented by the community insists that they have the advantage of altering the supply and demand in the stock market by borrowing shares from investors that are long in the stock and immediately sell them to the open market. Not only this, but some hedge funds pose a real threat to the financial system through suspicious activity and additional manipulative actions if proven to be true. Disturbing facts such as these are commonly discussed in meme stock communities. There is no better place than GME and AMC communities to interpret and deduct stock market discussions and corruptions. With this being said, there are multiple theories within these communities that discuss the possibility of stock market crashes. If you have enjoyed this video, please give it a like and subscribe for more content like this.